Welcome to The Explainer. Today, we're breaking down the complex and, let's be honest, often completely hidden world of professional liability. We're turning this into a practical survival guide for your business. So whether you're a consultant, an engineer, or maybe you're running a creative agency, the way you protect your professional legacy is about to get a whole lot clearer. Let's get right into it.
Okay, imagine this high-stakes scenario for a second. Nobody tripped in your office, no physical property was damaged, but a single typo, or maybe a slight oversight in your consulting advice, just wiped out your client's entire quarterly revenue. Are you actually covered for that? If you're hesitating even a little bit right now, you'll want to pay close attention, because a single error like that could literally financially destroy your practice.
Section 1. General versus professional liability. So, think of commercial general liability, or CGL, as your physical shield. If someone trips over a power cable in your lobby or your physical product malfunctions and ruins a customer's property, CGL steps in. It's really accessible. We're talking starting around 15,000 rupees a year for some pretty substantial coverage. But then you have professional liability insurance, PLI. This is your financial shield. It covers the intangibles, negligence, errors, omissions, or basically giving bad advice that causes an economic loss. Because financial damages are so complex, it's a much bigger investment, usually starting around 75,000 rupees a year.
To see why modern professionals usually need both types of coverage, let's look at a digital marketing agency. They absolutely need general liability, right? Clients are visiting their physical office all the time. But what happens if they accidentally use a copyrighted image or their massive new SEO strategy completely tanks a client's website traffic? That client is going to sue for financial damages. A general liability policy won't do a thing for them there. That's a completely different risk, and it requires a professional liability policy to actually protect them.
Moving on to Section 2. How claims-made policies work.
Okay, the absolute most crucial concept to grasp here is your retroactive date. This is a very specific date set by your underwriters, and your policy only covers work done after this date. Seriously, if you get sued today for advice you gave, say, 5 years ago, but your retroactive date was only set 2 years ago, you have zero coverage for that claim. None. You always want to push this date as far back as possible to make sure your past projects are actually protected.
Now, professional liability almost exclusively relies on a claims-made model. Under this model, underwriters are looking straight at your past activities. Why? Because the projects you finished last year, or even 3 years ago, are exactly what trigger most claims today. Compare that to an occurrence policy, which is a lot like your standard car insurance. That only cares about incidents that happened during the current policy year, regardless of when they're actually filed. But because professional advice has such a long tail of consequences, insurers have to look at your historical revenue to accurately price your current risk.
Section 3. Beware. Defense within limits.
This is fascinating. Take a look at this official notice directly from the State of Connecticut Insurance Department. They actually issued this to explicitly warn consumers about a sneaky little clause called defense within limits. It proves that the legal defense costs your insurer incurs will actually be subtracted from your total coverage limit. They literally mandate that insurers disclose this up front because it drastically changes how much actual protection you're getting.
Let me put this in plain English. If you aren't careful, your financial shield could be completely devoured by attorney fees. Imagine you have a $1 million policy limit. You get sued, and just defending this super complex claim costs $800,000 in specialized lawyer fees. Well, that leaves you with only $200,000 to actually pay the settlement. If the settlement comes out to $500,000, you're paying that $300,000 difference straight out of your own pocket. Always check if your defense costs are inside or outside your policy limits.
Section 4. The vicarious liability trip. So, who exactly pays if your contractor makes a massive mistake? Welcome to the vicarious liability trap. This is the legal principle where you can actually assume responsibility for the negligent actions of someone else. Just because someone isn't officially on your payroll doesn't mean you aren't on the hook for their slip-ups.
Let's actually map out your exposure here. Now, your direct employees, they're usually covered automatically under a standard PI policy. But let's look at the others. If you're using umbrella company staff and you're the one directing, supervising, and controlling their day-to-day work, that liability usually shifts right over to you as the end hirer. On the flip side, if you hire a managed service provider, an MSP, they're typically responsible for delivering an actual service outcome, not just providing a warm body. So they generally assume the primary liability. The big takeaway here, your contracts dictate your liability. Never just assume your subcontractor's mistakes won't magically end up on your desk.
Section 5. Taking your practice global.
Expanding your business globally is exciting, but it means navigating an absolute maze of local regulations. Some places are a breeze. Costa Rica, for example, easily recognizes your existing coverage by treaty. But then you look at places like Canada or China. They absolutely do not recognize outside coverage, and they demand that you have entirely separate local insurance policies. If you're doing consulting work in a country that requires local insurance and you don't have it, your domestic policy is practically useless. You've got to check those local laws before you send out that international invoice. And finally, Section 6, Runoff the Business Afterlife. Remember how we talked about those claims-made policies earlier? Well, this is where that structure can really come back to bite you. If you cancel your insurance the exact day you retire, you have absolutely zero coverage for a claim made the very next day. Even if you did the actual work perfectly years ago, your legal responsibilities just don't vanish the second you lock your office doors. And that is exactly why runoff insurance is an absolute necessity. Check out this timeline to see how long you're actually on the hook. The standard statute of limitations for someone to claim negligence or breach of contract against you is generally 6 years. But wait, it gets crazier. If your contracts were signed as deeds or depending on certain strict liabilities, you can actually be held legally liable for your professional advice for up to 15 years after the work is finished. 15 years? Runoff insurance is designed to cover this exact massive gap. You basically have two main strategies here. First, there's year-on-year coverage where you just renew annually. The great thing about this is the flexibility. Plus, your premiums usually drop every year you go without a claim. The downside, you have to actually remember to renew it every 12 months, and if the market suddenly shifts, you could get hit with unexpected price spikes. The alternative is multi-year runoff. You just buy a 2 to 6 year block of coverage at a fixed price. There's no annual renewal hassle, but of course, it's a much bigger hit to your wallet up front. Choosing the right one really depends on your professional institute's rules, like accountants, for instance, who are mandated to carry 6 years, and obviously your own retirement budget. So, I want you to take a hard look at your current shields. Check those retroactive dates, comb through your subcontractor agreements, and definitely verify your defense limits. Ask yourself, if you locked your office doors for the last time tomorrow, are you absolutely certain your professional legacy is protected? Thanks for joining me on this explainer. Now seriously, go check your policies.